Welcome, everyone, and thanks for joining us for today's webinar. Secure Act regulations require RMD first. This webinar will last approximately 15 minutes, and at the end, we'll tell you how you can request supporting materials related to today's content. Today's presenter is Linus Sujas. Linus worked for a Chicago-based insurance company in various roles, including Director of Advanced Sales and as Chief Marketing Officer. He ran and sold a successful estate planning practice in Franklin, Tennessee. Linus also writes the publication Think About It, founded by life insurance industry guru Steve Limeberg. Linus will draw on his legal, tax, and life insurance background and his practical experience for today's webinar. But before I turn it over to Linus, we are going to go ahead and launch our poll for July's webinar. I'm going to give everybody a minute or so to vote on the topic that they would like to hear in July. We've got about 20 more seconds, so if you would like to vote and haven't yet, please do so in the next little bit. All right, it looks like for July, we will be covering the complex world of modified endowment contracts. Thanks for everybody participating in that poll, and we look forward to talking about that in July. And now I am going to go ahead and turn it over to Linus.
Hello everyone, and welcome to today's webinar entitled Secure Act Regulations Require RMDs First. I'm glad you joined us today. As a reminder, next month's webinar will be entitled Dealing with Do-It-Yourself Clients. Like all of our webinars, it will be held on the first Wednesday of the month at 11 o'clock Central Time. You're welcome to come. These webinars are held the first Wednesday of each month, and they are free of charge to those who are in the life insurance and financial professional business. If you know of someone who would benefit from attending the webinar, please let us know. They are welcome to join if you send a message to us. So let's go ahead and get started with today's webinar. The Secure Act regulations require RMDs first. The first thing we'll talk about is we'll look at the actual regulation that was offered by the Secure Act. It is in the nature of a clarification rather than a new idea, and we'll get into that a little bit in a second. We'll go through 3 examples that demonstrate the pitfalls associated with the RMD first rule. These are pitfalls that Jennifer and I at Advanced Underwriting Consultants often hear about when we're talking with financial professionals. And then we'll give some conclusions, make some conclusions about how best you might use the information contained in today's webinar. So let's go ahead and get started. First, let's talk about the clarification offered by the Secure Act's regulations. These are the final regulations for the Secure Act. And here's what those regulations say. If you read through the direct quote that we've pulled from the final regulations, you'll see that what the IRS has essentially said is that the first distribution from an account, when an account owner is of an age where an RMD is required for the year, the first distribution must go towards satisfying an RMD. This is not a new idea. The IRS has said this kind of thing before, but they've never really put it in the form of a regulation. Now it is a regulation, and regulations have a much stronger legal effect. And so you should expect carriers, if they have been a little bit forgiving in the past about this idea, where they've perhaps allowed for distributions from an IRA that weren't considered to satisfy RMDs first, you should expect carriers and other IRA custodians to be more rigorous about this in light of the regulation. So let's go ahead and talk about 3 instances where I think that the RMD first rule is going to come into effect and is going to play an important role in you serving your client. Let's talk about Seth, who turned 75 in 2024, had just one traditional IRA with a balance of $100,000, and he decides to roll over the entire value of his account to a new IRA using the 60-day rollover method. And we remember that we're only allowed to do one 60-day rollover per year from IRA to IRA. But let's assume that Seth is doing just this one. So Seth takes a complete distribution of his existing IRA in 2024, and within 60 days, he deposits that $100,000 into a new IRA. He received Form 1099-R from the old IRA custodian, reporting a $100,000 taxable distribution, and Seth is prepared to report the fact that he completed a 60-day rollover on his personal income tax return. And the instructions for Seth for filling out his Form 1040 explain how it is that he should report that properly on his income tax return. Now, this seems to be a fairly straightforward transaction, but Seth has not complied with the RMD first rule. He had an RMD obligation in 2024 of just over $4,000. If he tries to roll over all $100,000 of his existing IRA into the new one, Seth's actually made an excess contribution of that just over $4,000 RMD obligation, because the 2024 RMD amount was not eligible for a rollover. Can Seth fix the situation? Yes, but it requires deliberate steps. Seth has to take out the $4,065 plus any earnings associated with it on or before the due date for his 2024 income tax return, including extensions, right? And so if Seth is dealing with this right now, the only way he'd be able to legitimately fix it is if he had filed an extension for his 2024 income tax return. If he in fact takes out the excess amount prior to the extended due date for his return, including any earnings associated with the excess amount, then it's treated as if he never made the excess contribution and everything is fixed. If, on the other hand, he doesn't do that, he's potentially on the hook for a 6% tax on an excess IRA contribution, and that penalty tax is applied every year for which the excess amount remains in the IRA account. So you can see that this is a real pitfall, and it's something that should be thought about in situations where clients are RMD ages and are moving qualified funds from one account to another. Let's talk about another example. Let's change the facts so that instead of an IRA account, an old IRA account that Seth is dealing with, he's got a Section 401k account that's worth $100,000. And he intends to, instead of doing an indirect rollover, he's going to perform a direct rollover from the 401k plan to a new traditional IRA. And the plan administrator, in accordance with the rules, has sent Seth a Form 1099-R reporting the distribution code G, direct rollover of a distribution to an IRA. If Seth, again, does the complete direct rollover of $100,000 in a year for which he has not yet satisfied his RMD obligation, Seth will again have made an excess contribution into his new IRA, and he's got to fix it in the same way that we described for the IRA situation. Got to take out the excess plus any earnings associated with it on or before the due date associated with his 2024 income tax return. Let's talk about a third potential situation where this can create some difficulties. So let's talk about Seth again, and let's consider the possibility that instead of doing an indirect rollover of his IRA or a direct rollover of his 401k account to an IRA, Seth instead transfers an existing IRA account balance to a new IRA. And so what happens then? Well, first of all, if you look at the instructions for Form 1099-R, you'll see that the IRS does not require the IRA custodian to send a Form 1099-R when there's a direct transfer of an IRA account balance from one IRA to another. Now, a lot of financial institutions do, in fact, send Forms 1099-R, even for an IRA to IRA transfer, but the IRS does not require it. And so there's a possibility that somebody is going to not take their RMD, and this amount won't necessarily be reported to the IRS as a taxable distribution. And there's some ambiguity over whether an IRA to IRA transfer is a distribution for the purpose of the RMD first regulation. It's possible that the taxpayer and the taxpayer's tax professional could argue it is not a distribution. It's simply the act of changing the IRA account's custodian. But that's not clear. Most of our clients would not want to take the risk if they're given complete information about the RMD first rule. And so even where there is an IRA to IRA transfer, our strong belief is that the best practice is to take the RMD first before doing any IRA to IRA transfer where the account owner has an RMD obligation. So how should you use the information that we've discussed during today's webinar? Well, I think you want to inform your client, first of all. The IRS's published regulations makes it clear that the first distribution a year must go towards satisfying an RMD obligation. This is a clear thing, and so our clients and their tax advisors should be informed about it. In all cases where someone is moving money in a year in which they have an RMD obligation, our strong recommendation is the first thing they do is to take their RMD before proceeding with any rollover or transfer. And the reason is just to avoid any drama that might occur later on. Unfortunately, the world isn't perfect. There are going to be situations in which the RMD first rule is not followed. And so what it is that we hope you will take away from today's webinar is that you can help your client solve those situations, usually by taking out excess contributions by the due date for the return for the year in question so that the drama associated with an ongoing excess contribution can be avoided. I think it's the best practice. You certainly want to work with your client's own tax professionals while you are doing these things, and you want to bring them up to speed on what it is you're doing and why it is that you're doing it. At this point, I'd like to thank you again for joining us for today's webinar, and I will turn the program back over to Jennifer to close this out. Jennifer?
Thanks, Linus, and thanks for joining us today. And don't forget to join us in June for DIY clients. As a reminder, if you would like to receive supporting materials for today's webinar, feel welcome to email us at asktheexperts@advancedunderwriting.com. Again, that's asktheexperts@advancedunderwriting.com. Please check out our YouTube channel to view today's webinar as well as all of our past webinars. For more information about the services that Advanced Underwriting Consultants offer, including phone consultations and newsletter licensing, feel welcome to call us at 615-224-1291. Again, that's 615-224-1291. Thanks again, and best wishes for continued success.